G'day folks, Adam Renouf from Partners Financial Planning. Hope all is well. And I have Cam Gleeson back from BetaShares this week to talk about CLDD, so cloud computing software, etc., that we mentioned a few weeks ago. This one is an absolute ripper, and as a matter of fact, one of the stocks involved in it we're using right now, which is Zoom. So g'day Cam, and thanks for helping us yet again.
Thank you, Adam. Pleasure to be here.
So let's talk about cloud. It's I think the infographic is fantastic for a start. It sort of tells us what it's all about, and then mate, this is a crazy part of the market, I think, moving forward.
Yeah. I guess that infographic would have been described probably 10 years ago as the information superhighway, but I guess we call that cloud now. So look, I'll jump straight into it. Obviously, everything is general in nature that I'm talking about today. But we're very pleased to have launched cloud, as we just described as cloud. CLDD is the ticker code, but our global cloud computing ETF, investing in companies involved in cloud computing. We launched that in February of this year. And really, when we're talking about cloud computing, in simple terms, cloud computing is really just the provision of computing services such as data storage, computational power, and all the way through to software, almost the end product that a user might use through or over the internet, where those applications are hosted remotely. And we think about how cloud computing has evolved and really the way that IT departments are structured within companies. You used to have an IT department. They would buy some servers that were stored on premises in a server room or maybe even a cupboard. And then the CIO or whoever was in charge of IT would go out and buy some licenses for the latest version of particular software, and then have an IT team to make sure that maintenance, security, upgrades were all sort of up to date. What cloud computing has allowed is really a simplification of the model of providing IT services, enables you to outsource a lot of those particular functions. And rather than having an upfront lumpy fee that needs to be paid every couple of years to upgrade your servers or update your software, cloud computing allows an annual subscription fee or a payment per use. So it allows real scalability, but it also means that whoever manages IT doesn't have to go cap in hand asking for another big round of expenditure every couple of years. So certainly good from managing the business's perspective.
And people are probably more thinking about this since COVID, right? This is in the COVID norm that we're talking about.
That's right. Yeah, I mean, obviously with people moving remotely, cloud has become an increasing part of our daily lives. Just wanted to sort of describe, the various attributes of the cloud ecosystem. As we show that as a pyramid on this chart, and that's because each of the, if you like this, the subsections of the value chain really build off the levels below that. Not to say that this pyramid represents the relative size of these segments. Software as a service, the top section, is actually the largest segment of the expenditure in cloud computing. So if we think about software as a service, we're simply talking about software. And to give an example, Xero is a really good example that a lot of people use. That is a cloud-based accounting software solution, yep, where you pay a per user charge to access that. All of the data is hosted in a cloud. So it's hosted within one of the public cloud companies. So ISS, a couple of levels down, is the cloud infrastructure. Okay. So it's merely a way of hosting all that data remotely, and enabling best of breed software and security for that solution. So very much an end user focused part of the cloud there. Then we start moving into the areas which are more the domain of the IT department. So platform as a service is services provided to application developers to enable them to configure software for their end users. So rather than someone in accounting using Xero, a platform as a service, there are companies like Salesforce and Twilio, where developers can configure and build applications without having to worry about a lot of the messy back-end IT stuff around the provision of those applications, mm-hmm, and development. And then the section that people are most familiar with is IaaS, or infrastructure as a service. And that's what we know as those big public cloud companies, like Amazon's AWS, Microsoft's Azure, Google Cloud, Alibaba Cloud.
Yep.
They're the ones that people are most familiar with in terms of names operating in this space.
Yep.
There's a bunch of specialized cloud providers, and you might have read recent news articles about Fastly or Akamai, and these are companies that provide, if you like, specialized cloud infrastructure, often described as content delivery networks that operate within that space.
Yep.
So all those portions of the pyramid are services provided to a cloud customer. The two portions below that in the pyramid are what those cloud providers rely on to be able to provide those services. So specialized componentry in order to build basically a bank of database, a bank of servers and the networking required. And then finally, we need somewhere to host that cloud. And there are specialized real estate investment trusts that specialize in providing, if you like, the real estate for cloud providers.
Okay.
So just to look at the, what's happening within this market, and these are estimates from Gartner. What's driving cloud really has been the exponential growth in data, and we can see that in a number of places. If we think about, for example, the way that Tesla's business model runs and the way that their cars operate, these cars create an enormous amount of data because they're using, if you like, sensors, in particular cameras, and visual data is a very intensive in terms of data. Collecting data every time that car drives out on the road. You drive your Tesla out on the road, data's being collected. You drive back home, you park your car, you plug it back in, all that data is being uploaded back to Tesla so they can improve their self-driving software. And the analysis of that data then creates more data. So you've almost got this sort of, data squared sort of, framework that we're operating in. As a result, we're seeing this exponential growth. And we see that growth, like annualized growth in software as a service, 17%. Platform as a service, and then infrastructure as a service, even higher growth rates within these segments.
It's massive numbers, isn't it?
Absolutely, yeah. And if we look at the actual companies involved, like for example, Microsoft, their recent earnings has really been driven by cloud computing. So we can see how it's impacting individual companies who may not be entirely dedicated to cloud. They're becoming increasingly dependent on their cloud services within their own businesses.
Yeah.
So why have we seen this growth? I mean, the cloud model really is seen as a win-win-win. So we talked about that scalable on-demand infrastructure that cloud offers. But if we think about once a company's migrated to the cloud, those customers tend to be very sticky. The cost base for offering cloud services is relatively fixed because the infrastructure available is very scalable. Yep. And so if we think about software as a service companies, I mean, these companies operate at very impressive gross margins. So if we can see that chart on the right-hand side, the line in black shows the gross margin across software as a service companies, and that's tracking a bit above 70%. Yeah. So every customer dollar of subscription revenue, roughly 70 cents is going to the bottom line. So that's incredible rate of
good business
margin capture, yeah, and the growth rate, tracking around about sort of 10-15%. So these are great businesses. And if you think about a growing business, ideally, if you have a growing business, it can cost money to drive that growth. Yeah. That means as an equity holder, you often have to raise additional capital, which dilutes existing shareholders just to fund the growth. But if you've got a business which is able to reach the trajectory of positive earnings and spitting off that level of margin, it's a fantastic business to be part of.
Yep. And simply, when you look at your graphs there as well, you can see that it's nice, consistent growth. Where you say this is the scalability option, right? That's the best part.
Yeah, that's right. That's right. So extremely interesting business to be a part of. I mentioned the software as a service business as being roughly sort of 70% gross margins. Yep. Your big cloud infrastructure providers like Amazon, they're tracking at around about 30-35% gross margin capture. So across the entire value chain of cloud, that there is some extremely attractive margins available for those that can get to scale and then get those customers and capture more customers with successful products. And you can see a number of brands here which are obviously very successful. Yep. So Shopify, Xero, Zoom, obviously, these all operate within the software as a service and all platform as a service to some degree with Shopify. Incredible businesses. And if we think about the way that the index for cloud is constructed, we're quite mindful of creating the right types of thematic exposures. The index itself is made up of a 90% allocation to companies who we would describe as pure play cloud exposures.
Yep.
So that's companies with over half their revenue from cloud-based services, and those services or sub-themes are shown on the left-hand side as we described before. 10% of the index is actually reserved for companies that have less than half of their revenue from cloud services, but are significant in terms of the overall revenue they generate from public cloud infrastructure. So over $100 million from public cloud infrastructure. That's designed to capture the Amazons, and the Microsoft Azure. So there's a 10% allocation to those very large public cloud companies that sit within a diversified tech company. That's because, if you like, this industry is evolving. So we want to capture mostly a pure play exposure to these leaders that are concentrating on cloud, but also have that underlay of exposure to those large cloud providers. I can talk about some of the names here. They're very, interesting names, but just to think about, some of the themes that have been quite interesting of late. Fastly, I might have mentioned this one, but Fastly is a content content delivery network. Yep. It's essentially a company that allows data to be stored closer to the end user. There was recently a news story about their network going down and impacting a swathe of global newspapers. When you think about when you're accessing a newspaper article, there are elements to that newspaper article that take up a lot more data, in particular, the videos and the pictures. The slower the load time, the more likely you are to leave the page before that video or image is actually loaded. Mm-hmm. So they benefit from customers that want to see really quick load times in hosting those particular, if you like, data heavy parts of websites. Yep. Now, Fastly had an outage of about an hour due to a code release. Resolved the issue very quickly. Fastly's share price actually, increased by about 30% over June, because it really uncovered, just how many customers they had. So it's quite interesting in terms of a stock price reaction to that. Yeah. Yeah. So we've also seen some interesting, like we've had, there's a data center REIT which has recently been taken over. So there's a bit of M&A activity in this space too. So we have seen, cloud appreciate around about 11% for the month of June. So good performance. Well, but we can see longer term performance. Yep. We're comparing that to the NASDAQ 100 index here. So NASDAQ 100 index obviously has had stellar performance, 24% per annum over a long period of time. Cloud, obviously the compounding effect means that the gap just widens, but you'd be very happy with 30% return. It is so outperforming NASDAQ. Largely due to, as I mentioned, that revenue capture and the fact that these companies are becoming, increasingly profitable.
And we'd think the way the market's moving is, or the world's moving, is this sector has to get bigger and bigger. Well, the exposure to it has to get larger.
Yeah, absolutely. It's just becoming, more and more integrated with our daily lives. Yeah. So look, I'd happy to take any questions, Adam, if you had any specific points from there.
So I noticed because I actually got the profile up next to me. Mm-hmm. I would have thought it would have nearly been 100% exposure to the United States, but it's actually like there's a reasonable chunk ex of the US. So what's in Canada?
Yeah, good question. So in Canada is Shopify is a very large cloud provider. I'm just having a look here. So they're the first number one holding. Yeah. So just looking on our website, so you can find all this sort of information on our website. Yep. That's I believe would be entirely Shopify in terms of that weighting. Yep. See that New Zealand allocation?
Yeah. That was my next question.
Yeah, that's Xero. So
right. So Xero is based in New Zealand.
Well, it's based on a country of domicile. So Xero is listed in Australia, originated in New Zealand, if you like. You know, and the China allocation, just so you know, will be Alibaba, who have a large and growing cloud business.
Absolutely.
You know, Xero is a fantastic company. Xero actually only reached profitability in around about 2 years ago. And so a lot of these companies are only just getting to the level of profitability now. But if you look further out, the growth rate in their earnings means that they do look like a very attractive set of businesses a few years out.
Yep.
Albeit Xero, when it first reached profitability, had $1 million of profit and traded off a price to earnings ratio of about 1,000, purely due to the fact that it only just reached profitability. But those P ratios are just coming in as those profits keep increasing. So,
and like you say, it's sticky business. Once people are used to Xero, they're not going to be changing to their competitor or something like that, are they?
It is a bit difficult to do so once you're in bed with one of these providers. And look, generally that speaks to a good product.
Absolutely right. Absolutely. Mate, that's fantastic. Thanks, Cam. I really appreciate your help and advice yet again. You're fantastic with your information, and the way you distribute it is brilliant. So if anybody's got any questions or any other information that on Cloud, please let us know. We're more than happy to place trades for you as we normally do. And thanks, Cam. I look forward to catching up with you next time. And thanks for your help yet again.
Great. Thanks, Adam. Good to chat.
Cheers, mate. Take care.